What's up, everyone? It's Brand the Mortgage Man here, and I've helped more than 10,000 home buyers over my 22-year career in mortgages, and today I'm here to help you. So in this video, I'm going to show you ways that you can actually get a credit from a seller of a property when you're buying a home to help cover your closing costs on that property. I'm going to show you how much of a credit you can actually receive depending on the type of loan you're receiving, and then I'm going to show you how to apply those credits to a specific scenario. So let's get right into it. First, let's look at the max credits you're allowed to receive depending on the type of loan you're getting and your down payment. So let's start with FHA. So on an FHA mortgage, which is very common for first-time home buyers, it's not only for first-time home buyers, so check out my video on FHA mortgages specifically. But seller credits on FHA mortgages are 6% maximum, meaning 6% of whatever your loan amount is. Next, we'll say VA, where you have to be a veteran, a widower, or you have to be active duty military. On a VA loan, you can get up to a 4% seller credit. And then on a conventional loan, which a lot of you will be looking at, whether you're looking to buy a primary residence, something you're gonna live in, or you're looking to buy a second home, you're allowed to get up to a 9% seller credit, but this varies. So technically, if you were putting down less than 10%, you're gonna be looking at a 3% seller credit. If you're putting down 10% to 24.99%, you're allowed to get a 6% seller credit. And if you're putting down 25% or more, that's when you're allowed to take advantage of the full 9%. Most people fall into this category, right? They're putting down somewhere between 3% if they're a first-time home buyer to 10%, most in the 3 to 5% range realistically. So what we're gonna do is we're gonna run our scenario using let's call it a $500,000 purchase price. And I'm not gonna be focusing on payment. I just wanna make that clear. In this video, we're strictly talking about how to apply seller credits. So $500,000, you're allowed a 3% seller credit. So all we do is take your loan amount, multiply it by the amount that you're receiving. So we'll use the max in this case. And that gives you $15,000. This is the maximum seller credit that you're allowed to receive if you're getting a conventional mortgage with less than 10% down on a $500,000 property, right? It's your 3%. Now, how do you get the seller to give you $15,000, right? Who just wants to give up money? That's coming out of their pocket. Well, there's different ways in which you can do it. And this requires you to work with your lender and with your realtor to come up with how to go about it. So the first way is simply just to submit an offer on the property and ask for the credit, right? Say, we're submitting this offer for $500,000. And part of that offer in the additional terms section of your contract is we want the seller to contribute 3% of the purchase price toward the closing costs. Pretty simple, but that has to be written into your initial offer within the contract. Another option is if the seller's unwilling to budge, well, maybe what you do in that case is you say, okay, forget $500,000. You're asking $500,000 for your property. I know you're unwilling to give a credit of 3% at that number. Maybe you don't have the flexibility, Mr. Seller or Mrs. Seller. So what we're gonna do instead is we're gonna take this $500,000, we're gonna add the $15,000 to that. So we're gonna increase the purchase price to $515,000. And then from there, we're gonna give a $15,000 seller credit. What's nice about this is the seller is still gonna walk away with their $500,000 that they initially wanted, and you're gonna get the $15,000 that you wanted. A lot of clients, I've talked to them, they say, oh, I heard I can finance my closing costs into my loan. Well, there's no real way to do that other than this. You'd have to increase your purchase price and then get the credit back, and that's essentially you financing the closing costs into your loan. If you already own the property and this was a refinance, we would use your own equity and you could go ahead and finance the closing costs into the loan. But on a purchase, this is really the only way to make that happen. So this is very common. It's something that we see often. We actually see this happen at times when you're already in the process. So let's just say you didn't negotiate a credit up front, or you wanted a credit and the seller did not agree to that, right? They said, no, we're not giving a credit. We don't think the property is going to appraise high enough to cover that credit, because that could be the case. Maybe the $500,000 they're asking for the property is the market value, right? And they think by raising the price to $515,000, it's not going to appraise, and lenders can only lend on the lower of the purchase price or the appraised value. So What a seller might be thinking is, hey, I'm not going to raise my purchase price $15,000 to then have the property underappraised, and you as a buyer think I'm still going to give you $15,000. So you got to understand their mindset when it comes to that. However, something that could happen is this. You agree to $500,000 and then you have an appraisal done. So an appraisal is something that the lender is going to order to determine that what you're paying for the property is actually what that property value is. And they do that by pulling comparable sales of homes that are just like the one you're buying, meaning they're the same general size, same bedroom, bathroom count, same upgrades or as close to possible on that. Now, the appraiser is going to make adjustments because they're never going to find the exact same home. However, they're going to look at comparables. They take anywhere from 3 to 6 comparables, and they put most of the weight on the first 3, and that's going to help determine if what you're paying for the property is what it's actually worth. But there are situations where maybe you decided to pay $500,000 for the property, seller agreed. They wouldn't give a seller credit. However, appraisal comes in and the property appraises for $510,000. Well, what we've done for clients and had clients go back and renegotiate with sellers on is in these situations, right, we have a surplus of $10,000 over what you're paying for the property. So if getting a credit to help with closing costs was important to you and you couldn't get it up front, well, when the appraisal comes in, you can go back to the seller or have your realtor go back to the seller and say, hey, property overappraised by $10,000. We'd like to raise this price, the $500,000. We'd like to raise that to $510,000. But by doing that, we would like a $10,000 seller credit. So what this does is it essentially does what we were doing here, but doing it at a different point in the contract. Rather than up front, it's happening during the transaction. So the seller is giving the 10 grand. It's not affecting their bottom line because you raised the purchase price by 10 grand. We already know the appraisal supports that number, so the seller doesn't have to worry about the property under appraising because you've already surpassed that portion of the transaction, and it solves for everyone. Seller gets the money they're expecting, you get the money you need or want for the transaction. And what's nice about it is by you receiving that seller credit, now it frees up money for you to do other things you might want to do in the property. Maybe you want to make some upgrades. Maybe you just want to have an extra 10 grand sitting, in this case, sitting in your bank account after you close as reserves, because you never know what's going to pop up after closing. It never hurts to have extra money left over after you close on a property. You never really want to use every penny you have in your bank account when you're buying a home. If you're looking to buy a property and you're looking for ways to reduce the amount of money that comes out of your pocket at the time you close, a seller credit / seller concession is a great way to do that. Now, if you want more detail on other ways to reduce your costs and how to get these seller credits and how they can be applied, make sure to check out my video where I talk specifically about the types and ways in which you can use this money outside of this one example. Once again, I appreciate you spending the time with me. Brand the Mortgage Man. Make sure to subscribe for more videos just like this one. Comment below with your own scenario and I'll answer it for you in another video.